A couple of weeks ago, DeepSeek came out and shocked the world. The stock market was in full panic, and so a lot of stocks did dip and even crashed. Of course, since then, we've had a solid recovery. Since then, we've had plenty of big tech companies talk about the positive effects that something like DeepSeek will have on the AI revolution. So I do want to touch on 3 companies that, in my opinion, will be positively affected by it and might still be in the buy the dip category. One of the 3 has not really dipped that much, and that's why it's also in this video, because this company actually saw these things coming, saw the fact that maybe they do not have to invest that much in GPUs just yet. So let's discuss all of that in this video. If you enjoy this type of videos, hit all the buttons. We'd really appreciate that. We're just surpassed 80,000 subscribers, so I really appreciate all of the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first up here is Adobe. Adobe, of course, got hit year on year. It's down 15% because of AI, not even because of a DeepSeek, but because of AI that might hurt its business. Adobe is also coming out with their own solutions, right? Adobe Express, Adobe Firefly, etc., etc. But the big question here is, can they monetize it? What's going on with the AI credits, the monetization part of it? I said from the start, 2025 is really the year where the market wants to see that monetization part of it. They will report earnings mid-March, so I guess we'll have to wait until then, but we do have some information more specifically with regards to text to video, a model that they released not so long ago. I'll explain all of that throughout the video. So right now, Adobe has a market cap of just over $200 billion and a forward PE of 22.7 times. Looking at the average analyst price target, that sits close to 24% higher than the price we're at today. Moving on and looking at some pricing metrics, so forward PE, EV to EBITDA, price to sales, price to free cash flow, and then price earnings to growth, we can see that right now the stock is cheaper than the 5-year mean. Now, zooming out a little bit, looking at what has happened previously and what's expected in the future with regards to revenue growth and free cash flow growth, we can see that free cash flow is expected to grow by 17.1% in fiscal 2025, which is faster than revenue, and then another 12% or so in fiscal 26, and then just 6.5% in fiscal 2027. So more recently, as you can see, free cash flow in the last couple of years has stayed flat-ish, and that's a problem, which we're going to talk about that in a second when you're going to look at free cash flow margin, because usually when you see revenue go up, you want, well, free cash flow to go up as well, and you want that free cash flow margin to at least be stable and not decrease. Of course, the best case scenario is a free cash flow margin that continues to go up. Now, like I said, AI credits, that's where, well, all the eyes are at when we talk about Adobe. More recently, Adobe said that they are expanding generative AI offerings, delivering new Firefly app with industry's first commercially safe video model. There are going to be 2 tiers at the moment. You have Firefly standard plans that will enable access to 2,000 video and audio credits per month, and the price will be starting at $9.99 USD. Then you have Firefly Pro, and that will start at $29.99. And to be honest, this is very important, the first commercially safe video model, because with all the other ones, it's great, you can generate images, generate videos, but what about copyright? What about licensing? Well, Adobe basically fixes all of this. For those that don't know, Adobe generates revenue from different segments: Creative Cloud, Document Cloud, Digital Experience, and Publishing and Advertising. If we look at where they generate that revenue from geographically, the biggest chunk, of course, in the United States, then Europe, Middle East, Asia, APAC, and other Americas. As for the margin profile, gross profit margin stays around the same 86-87% or so, but free cash flow margin is one that I said, you see, it has come down. We were closer to 43-42% before, and now we were closer to 35-37%. So this is definitely something we want to see change. We want to go back to that 40-43%, because the more free cash flow they generate, if the stock stays cheap, they can buy back even more shares. Moving on to company number 2, and that's Vertiv. Now, Vertiv, as you can see, they got hit more recently in the last month. The stock is down close to 19%, but of course, year on year, the stock is still up 75%, because this is a company that does gained or has gained a lot of momentum because of all of those investments in AI, in infrastructure, data center, and all of that. So Vertiv definitely a big winner there, but in the short term, it did get hit. They did report as well. The report was quite good, but as always, as we've seen in the past, its guidance. Guidance was a bit weaker than expected, but the CEO said, look, the trends are still looking great. DeepSeek basically does not destroy anything. It will just accelerate the AI movements. Just more and more people, more and more companies will start to build even quicker. And so that could benefit a company and will benefit a company like Vertiv. And if you've listened to management, they're usually quite conservative. They want to beat their own estimates. So yeah, maybe the bar has been set a little bit low to start the year. And then we're going to see some continued beats after each and every quarter. Now, Vertiv is not the cheapest stock out there, as you can see, forward PE 30.8 times and a market cap of $42 billion. According to the analyst estimates, they're expected to grow the bottom line, so EPS, much quicker than the top line, which is revenue. The average analyst price target still sits 25% higher than the price we're at today. And then looking at some pricing metrics, here we can see that the market is already giving this stock right now a premium, because if you look at forward PE, EV to EBITDA, price to sales, it is higher than the 5-year mean. But then again, beforehand, the company was not growing as quickly as right now. Plus, if you look at price earnings to growth, that's definitely not expensive, 1.12. So with Vertiv, what do we get? Well, we get some nice revenue growth, but like I said, EPS is expected to grow a bit quicker than revenue, and we're seeing that free cash flow for fiscal 2025 is only expected to grow by 10.5% after growing close to 49% in fiscal year 2024. But then we're seeing a reacceleration in growth. Fiscal year 2026 free cash flow is expected to grow closer to 40%, but then it's expected to be basically flat by fiscal 2027. Of course, it also depends a lot on the capex spending from all of the big players. Like we've seen, most of them are still going to spend quite a lot, but will that be true in fiscal 2026 and onwards? That's basically the big question mark. If you've missed their earnings report, this was basically the full year 2025 financial guidance. So again, it was good, but the markets were expecting a little bit more, especially when it comes to revenue. Zooming out a little bit, where does Vertiv generate their revenue? Well, the majority, no surprise here, Americas. Then we've got an even split from Asia Pacific revenue and Europe, Middle East, Africa revenue. As for the business segments, the majority comes from critical infrastructure and solution, and then the second part is integrated rack solutions, which has grown at a compound annual growth rate of just 3.9% since 2018, whereas the critical infrastructure and solution one has grown at 14.1%. Looking at the margin profile, well, back in 2017, gross profit margin sat at 33.8%. In 2024, that was at 36.6%. We can also see that free cash flow margin has now, well, turned positive and actually accelerating. In 2023, that was 11.3%. In 2024, that was 14.4%. Of course, with the likes of Vertiv and even Vistra, for example, and probably some other companies out there as well, it's another way to get exposure to that AI momentum, right? If you don't want to buy the big tech players or stuff like that, you can buy the infrastructure play. And Vertiv being Vertiv, I guess it's a good one. Moving on to the last company, and that's Snowflake. Now, I know already a controversial pick here because Snowflake is definitely not the cheapest stock out there. Actually, very expensive if you want to just look at a forward PE. It has a forward PE of over 200. Now, Snowflake is also software company, AI company, whatever you want to call it. But this one, just like many other software players, did not really get hit because of that DeepSeek announcement. On the contrary, the stock actually went up because of it. Because when you can democratize AI, when you can make these things cheaper, a company like Snowflake is definitely going to benefit from that. It can build more products, offer more products, better features to its customers, and that could, of course, increase their net retention rate. I think right now it's already quite high, all things considered, at 127% or so, which we're going to discuss in this video. But this is something that should benefit a company like Snowflake. Plus, I will read you a comment that was mentioned by one of the management folks back in September of last year. Now, right now, as you can see year on year, Snowflake still down 17%. But in the last 6 months alone, this stock has gone up by 50%, well, close to 50%. Of course, a huge jump after the last earnings report and earnings call a year ago. CEO switch as well. They started the year with some guidance that was weak, but then again, new CEO coming in, you want to lower the bar so the new CEO has an easier time beating those estimates, and that's exactly what has happened. The current market cap sits at $63 billion. Looking at the average analyst price target, that's basically flat, it's basically at the price we're at today. Remember, they are going to report earnings a week from now, well, Wednesday, next Wednesday. So if you think that's risky, if you want to wait, I guess you'll have to wait just over a week to get more information from management plus the report. Looking at some pricing metrics, surprisingly enough, it is lower than in some cases the 3-year mean here, but still quite expensive. Now we know that this company has grown revenue at a rapid pace. I mean, I know it started very small back in 2019, but the compound annual growth rate since then was 65.4%. I mean, all the way to 2027. Those are the expected growth rates. If you look at free cash flow is expected to grow 10.9% in fiscal 25, but then accelerate to 29.4% in fiscal 26, and then another 28% in fiscal 2027. So it's expected to grow, especially on the profitability side, very fast. Now going back to what was mentioned in September of last year. So they talked a little bit about GPU, pricing, supply constraints, and all of that. So Michael here said the following: the biggest thing that's going to impact the GPUs is really we are still a little bit of supply constraint out there. We have more than enough in where the majority of our customers are. There are some regions around the world where you still can't get GPUs through the hyperscalers. They just don't have the availability yet. But in the United States, I have no issues with GPUs. He also said, and I'm not going to buy any more GPUs until I see the revenue to support it. He was one of the first ones to actually say this last year, saying, look, it's great and all, but we just don't see why we should invest in more GPUs until the return on investment makes sense. So we're also probably going to see a nice little boost in profitability, in margins because of it, because they're just not going to buy more and more. I'm sure if there is enough demand, they will increase it. But right now, I mean, it does seem like it was the smart move to make. All in all, revenue-wise, they make basically the majority of its revenue, the large majority from product revenue, and then a very small part of it comes from professional services and other revenue. Looking at total customers, so total customers since the January quarter of 2020 has grown at a compound annual growth rate of 36.8%, and the net revenue retention rate still is at 127%. Yes, of course, it was much higher before, but still, 127% is very high and just shows the strength of Snowflake and the Snowflake basically marketplace, as they call it. Looking at the margins here, of course, gross profit margin throughout the years have grown quite nicely, closer to 68%. That's come a long way since the 46.5% back in 2018. If we look at free cash flow margin, of course, we went from a loss to now closer to 24-25%, which was a little bit higher previously. But like I said, this company is supposed to become more profitable in the coming years, because at the moment, if you look at net income, well, this is not a pretty picture. Moving on to remaining performance obligations, or RPO, that has also grown nicely year over year. If we look at total customers with over $1 million in product revenue, well, that also continues to increase. I mean, the growth for Snowflake throughout the last couple of years has been insane, and that's why it's getting such a high premium from the market. But I do think that now in 2025, it's a year where the market will demand them to show profitability. Yes, you can continue to grow that quickly, but of course, profitability is going to come into question. So if you get to see a dip for Snowflake, but the business still continues to do well, I think that's an opportunity. So all in all, that's about it. If you own one of the three companies, let me know down in the comment section below. Maybe you've bought the dip, maybe you're thinking of opening a position. Let me know in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.